Hello, my name is Kyle Rodder and welcome to this week's Investor Spotlight. Well, equity markets domestically in the US have seen a fresh batch of corporate earnings and trading updates. In this week's Investor Spotlight, we take a look at the latest news out of corporate Australia and America. On balance, Q3 earnings for S&P 500 companies were soft, if not underwhelming. Earnings growth for the quarter was 2.2%, below the consensus estimate leading into the period of 2.6% and the lowest number since the pandemic recession. The number of earnings beats was also below the long-term average. 69% of companies managed to exceed expectations, however, that was under the average of 71%. Revenues were slightly above for the quarter, but a squeeze on margins from higher costs were a large part of the EPS miss for the market. Of greatest import for investors, forecasts for Q4 earnings were progressively downgraded throughout the earnings period. Consensus estimates now point to a contraction of 2.1% for earnings in the fourth quarter. Notionally, last week was the last for corporate earnings in the States. 95% of companies have now reported, with some of the US retail heavyweights delivering their quarterly results. The numbers proved to be very mixed. Walmart managed to exceed expectations, delivering an EPS of $1.50 against the $1.32 estimate, driven by a solid revenue beat. The company also lifted its full-year guidance off the back of the result, but flagged challenges to the outlook as cost of living pressures increase in America. Target, meanwhile, proved a significant disappointment. It posted EPS of $1.54, undershooting the $2.13 forecast, as profits fell by more than 50% from a year earlier. It also flagged building headwinds to future profits due to the rapidly evolving consumer environment. Target shares dropped by as much as 15% on the day of the results and finished the week more than 5% lower. Data released last week showed US retail sales remains robust. Nominal sales increased 1.3% in October, exceeding the 1% forecast. A part of the reason for the increase was inflationary in nature. The nominal value of sales increased due to higher prices. However, it's clear consumption remains strong in the US and above the long-term trend, stoking questions about whether such a trend can continue, will begin to peter off, or whether retail sales are about to crash back to earth. The Australian banks have delivered several earnings results and updates in recent weeks. The ANZ posted full-year earnings at the end of October, revealing a 16% jump in statutory profit and 3% increase in dividends. The NAB posted full-year results at the start of November, revealing a jump in profits of 8.3% and a significant increase in its full-year dividend of 18.9%. Both results were underpinned by solid lending growth and widening margins as interest rates rose. CBA delivered a trading update last week and posted a $2.5 billion profit for its first quarter, an increase of 2%. Troublesome and impaired assets also decreased, while the bank hasn't flagged any increased provisions for bad debts going forward. Rising interest rates were cited as a tailwind for the bank, although the CBA did not provide numbers on net interest margins. CEO Matt Comyn reaffirmed his confidence in the medium to long-term outlook for the business and Australian economy, despite inflationary pressures. CBA share price has risen significantly recently, with the stock approaching record highs. The trend is ultimately sideways, with the price reaching technical resistance around $107 to $108 per share. A break above that level would open a run to fresh all-time highs, while support might be found around technical support and the 20 and 50-week moving averages around $100 per share.